Welcome back to the Retire with Confidence podcast. This episode is sponsored by CWOs for Hire, which is the financial planning firm that I co-own. We will soon be taking on clients again in a few weeks. Right now we're in the middle of the crazy planning season where we're meeting with all our clients and taking care of taxes and things like that. But in a few weeks we will be taking on new clients. So if you would like our help in working with you one-on-one, or would at least like to have a discussion around your questions and how we can best help, we are happy to do so again in a few weeks when we start meeting with new folks about their planning. We'd be happy to add you to that list. Just go to cwosforhire.com and click the link to book a time directly on our calendar. For this episode, I want to talk about some things that we've already covered, but I want to put it all together. In episodes 2 through 6, we talked about traditional IRAs, Roth IRAs, Backdoor Roth IRAs, and Roth IRA Conversions. So there's 4 episodes out there, but they're each chopped up, and I thought, especially with this being tax time of year when we are recording this, it'll be very helpful for people to hear all of those in one episode to get a clearer understanding of what all these tax implications are and why all of these pieces exist. So let's start with the traditional IRA, and we'll contrast this with the Roth IRA. With a traditional IRA, when you contribute money to it, you get a tax deduction in that year, as long as your taxable income levels, your adjusted gross income is really the proper term, as long as those levels are low enough, you can receive a tax deduction for your contribution. Now you can still make a contribution to a traditional IRA even if your income is too high, you just won't get the deduction for that, and we'll talk about that when we talk about backdoor Roth IRAs. But for now, when we're talking about traditional IRAs, just understand that when you put the money in, you get a tax deduction as long as your income is below the threshold levels for that year. But then when you take the money out, you get taxed on any withdrawals. So when you get to retirement, you take the money out, you're paying ordinary income tax on those withdrawals. So it's important to understand that dynamic of tax deduction now. It grows tax-free until you take the money out in retirement. Then it's taxed as ordinary income based on whatever amount you withdraw that year. It's also important to note that if you withdraw before age 59 and a half, you're going to pay a penalty. So you are very much incentivized to wait until 59 and a half to take that money out to avoid that penalty. There are some ways around the penalty. There's substantially equal payments. That gets really, really technical. That's for a whole nother day, a whole nother episode. But just understand that for most situations, you cannot get the money out before 59 and a half without paying penalty. There are some exceptions. We'll go over that a different time because we're trying to keep this one much more basic so you can understand what these different accounts are and how to use them. Now, real quick, before we move on to Roth IRAs, let's talk about 401ks, 403bs, workplace type retirement accounts. Anything that is a pre-tax contribution, pre-tax meaning it comes out of your paycheck before taxes are calculated, that's going to work very similarly to a traditional IRA. However, one of the benefits of these workplace plans is that you can contribute a higher dollar amount. And yes, you can do both. You can do both your workplace plan and an IRA. That's not a problem. Those are 2 separate pieces. But just understand that the pre-tax 401k functions just the same as a traditional IRA in terms of getting a tax deduction now, growing tax-free, and then being taxed when you take the money out in retirement. Now, a Roth IRA works almost the exact opposite. With a Roth IRA or a Roth 401k, same idea, you do not pay tax, you do not get a tax deduction on the contribution that you make. It grows tax-free, and then when you take the money out, there is no tax on those distributions. So this is really nice, especially if perhaps you are in lower tax rates now. You don't necessarily need a tax deduction, but this, whatever you put in gets to grow completely tax-free forever. And yes, there's some rules on distributions as well where you can't take it before 59.5, except for some exceptions. But generally, you're going to let that grow all the way until your retirement when you are 59.5 or older, and then you get to take the money out tax-free. So that's the big difference, is that the traditional IRA, tax deduction now, but you are taxed later when you take it out. A Roth IRA, no tax deduction now, but also no tax when you go to take it out in retirement, which can be really, really powerful. All right, so let's shift to Backdoor Roth IRA. Now, we talked earlier about there being income limits to make a traditional IRA contribution and have it be deducted. So you can make a traditional IRA contribution, that's not a problem. It's just if your income is too high, you don't get a deduction. Well, there's also income limits to contributing to a Roth IRA, but there's a way around that contribution. And that's where we get into what's called a backdoor Roth IRA. Now, this has been not necessarily validated by Congress, but essentially people have been doing it forever. As long as you do it properly, there's no issues. So I'm going to go through those steps. First step is you contribute to a traditional IRA. You do not get a deduction for it, but then later you convert those dollars from that traditional IRA to a Roth IRA, because there is no limit or restriction on conversions of a traditional IRA to a Roth IRA. Now, one important step is that you give it a little bit of time, and there's no specific rule on this, but you want to give it a little bit of time before you make that traditional IRA contribution and when you convert it to a Roth IRA. Otherwise, and we don't see this too often, but it's out there, there's something called the step transaction doctrine, which is just a fascinating term. But the idea is that even though you made these two pieces in two different steps, if you do them almost simultaneously, the IRS considers it to be one step. So if you do this, if you make the contribution, convert it right away, they're going to say, no, that was really a contribution to the Roth IRA, and your income is too high, so we need to unwind all of that and hit you with some penalties. Let's avoid that. But it has been shown to be perfectly acceptable to do this properly, to make the contribution to the traditional IRA. You don't get any tax deduction, but then you convert it to a Roth IRA after that. And that's what gives it the backdoor Roth IRA term. You're able to get the money into a Roth IRA even if your income exceeds the IRS limits. You just have to follow these steps and do so properly. Also, please be sure to track all of this on your tax return in Form 8606. I'm not going to go into detail on that right now, but it's really important to have this properly tracked on Form 8606. Keeps you out of trouble, keeps all the basis tracked, keeps your Roth IRA contribution basis tracked for history. Just really important to have that on that tax form. So if you're doing a backdoor Roth IRA or really any type of IRA conversion, please make sure that it's tracked on Form 8606. Which leads me into Roth IRA conversions. So when you are converting from a traditional IRA to a Roth IRA, I mentioned before there are no restrictions on the amount that you do. And we typically see this most often, but not always the case, but most often when people have retired, but they are not yet collecting either Social Security or required minimum distributions. Because there's a period of time where perhaps their income is lower from a tax perspective, and we can add income on purpose to their taxable income in order to pay money at lower tax rates now versus what they might pay over the long term. So when you convert money from a traditional IRA to a Roth IRA, again, take your mind off the backdoor Roth that we just talked about. This is just where you put money in a traditional IRA, over time. You got the tax deduction for those contributions, and now we're looking to convert it to a Roth IRA so that we're not taxed on it later. When this happens, you've got the tax deduction in the traditional IRA. Whatever money you convert gets taxed in that year that you convert it. So again, we're trying to intentionally pay taxes on this now at lower rates in order to then get it into the Roth IRA bucket that never gets taxed again. It's a really powerful planning tool. We have many, many episodes talking about what this is and why it is, but I wanted to put it in this context where we're talking about what the traditional IRA is, what the Roth IRA is, and what the backdoor Roth IRA is, because that next level is that Roth IRA conversion that ties it all together and is a really powerful planning tool. Again, we have so many episodes that talk about taxes and Roth IRA conversions and why we use them, so I won't go over that for this episode. But that way, now you've got one place to go to learn about the different types of IRAs and the different conversions, and also to, again, be sure, please track all of this on Form 8606 of your tax return.